It's fun to talk and write about equity markets, simply because many of us think when we come into the markets, whenever at whatever age we come, that when A action happens, B happens. For example, when a company announces good results, you expect share prices to go up, or when a company announces bad results, you expect the share price to come down. This is what intuitively you think. But what happens really is the market anticipates this already. Whether it anticipates 1 month in advance or 6 months in advance is out to debate. But this definitely happens in every market. So whether it is the US market or whether it is the Indian market, this happens. But the US market has got a funnier problem. When US comes out with good data, you expect US markets to go up. Fair enough, like any other market, that's what you expect. But what happens is when US comes out with bad data, the world thinks, oh, the whole world is going to come with bad data. So what should they do? They should go to safe haven. What is safe haven? Dollars or gold, right? So at that stage, they go and buy dollar. So you find that bad news about the US economy actually results in the dollar getting harder, because even now it is a reserve currency. Why is it a reserve currency? Because there is no other country willing to take over that mandate of being the reserve currency. Because to be a reserve currency, you need 2-3 things. You need a very big economy size. Just being a rich economy like a Sweden or a Singapore or even Japan is just not sufficient. You need the ability to absorb all the buying of your currency. So whether it is yen being bought or the Singapore dollar being bought or the Swedish kroner being bought, these countries can't afford that kind of hardening of the currency, because if the currency gets really hard, they will not be able to export, right? So it has to be a big country. So it has to be a country with size. It has to be China. It has to be India. It has to be Brazil. It has to be US. And they have to be doing very well. They have to be a rich country. So among these 4 countries which I named, it's only US which is capable of being the reserve currency. Now, because there is no other currency, China, US becomes the reserve currency. Now you realize that, well, there is bad news and the market goes up, because the market had anticipated that the bad news is going to come, and now they say, oh, the worst is over, so now we can buy the share or buy the index or whatever, right? So that happens. So checking out on all this on a regular basis, whether it is company data, whether it is country data, is good fun. And the companies which you own, you know the results that are going to be declared, you track them, you know what is going to come, and that is the time when you get a great opportunity to be either selling the share and waiting to buy it back after some time, or buying the share saying I will sell it on announcement of the results. Recently, if you saw Wipro go up from 420 to 472 when the results were good. It is still at 472, but one day it might come down lower, and then you will be able to buy, and maybe next result again you do something like that. So tracking the market on a regular basis is great fun. It is nice to see what the experts say about it, but you have to make money in the market, so that is very important for you. You see what the experts say, then you decide that, okay, let me sell off 500 shares and then I will be able to buy it back. Sometimes you're able to buy it back and sometimes you're unable to buy it back. So somewhere you feel that it is nice to track the market and write about it, but it is far greater fun tracking the market and trying to act on it and trying to make money, because when you put your money where your mouth is, you are able to derive the sheer pleasure or benefit of learning from the markets. And so having been in the market for a pretty long period of time, it's good fun to see how the market behaves. And some of my observations is also to see some of the non-intuitive relationships. Like, for example, now there is the cryptocurrency which you have to look at. There is the dollar which you have to look at. There is oil and other commodities that you have to look at. So if somebody comes and asks me, do you understand equity markets? I find that very difficult to answer, because equity markets are connected somewhere to the US dollar, somewhere to the gold, somewhere to the cryptocurrencies. So, and the psychology of the world. So if the whole world thinks that they should be bought, things go up. Simply because there is greater demand and lesser supply, prices go up. Take the reverse. When there is greater supply and less demand, then the prices come down. I was looking at my portfolio and got a little scared because everything is in the green, and that's very scary. Some natural resources fund is in the green, also the gold fund, mining fund is in the green, the regular funds are in the green, US is in green, Europe is in green, Asia is in green. It's a fantastic signal to know that one day, if your portfolio is completely in the green, everything is in the green, it just means one thing: I'm very poorly diversified. Because if one day everything can be in the green, one day everything can be in the red, that should not happen. At any point in time, some market should be in the red, and that's not happening. Even Europe has turned positive, Asia is positive, everything is positive, which means there is a good chance that some of these markets there will be profit taking, and people will remove some money from the table saying, I have had enough. Not that the market is going to go down, but I have had enough, so let me remove some money from the market. That's the time when you will get a chance, if the market tanks, for you to buy, which means you should be sitting on cash. It's very funny. You should be sitting in US because it's doing well. You should be sitting in Europe because it has not done well so far and it is likely to turn. You should be in Japan because Japanese economy is doing well. You should of course be in India. You should be in the large caps because large caps have not done so well. You should also be in mid caps because they are for the future. You should be in small cap. Given this scenario of everything looking attractive and everything looking very scary because of COVID, what do? Do you sit on cash? Do you invest completely and have no cash? No, you don't do both of this. You learn to maintain a balance. You have some money in every market, or whatever money you have in a debt market, equity market, and US market, Europe market, whatever. However you do the breakup, and then you pray and you hope things turn out well. When you need money in a booming market like this, you remove money from your equity fund, not necessarily from your debt fund. Keep your debt fund for bad times, remove equity for good times, but market could get higher, so you may be tempted to invest. Handling all these conflicts is what is going to make you money. If you think you have an answer for any of this which is confident and accurate, you're wrong. You will lose money. Don't bet on absolutes. Put some money everywhere and hope that some things turn out to be right, and you have more money in those which are right and less money in those which are wrong. That is the only thing you can hope for. Don't expect perfect information in this market. It's just not available. Thank you.